Hello, my name is Tanner Litchfield. I am an investor and a realtor based here in Utah. Today, I am going to talk about the differences between subject to and seller financing. These two strategies are completely different. And I will tell you, I have lost $180,000 on a subject to deal. In seller financing, there's a whole lot less risk involved. So let's start with subject to. Subject to is when you are taking over a loan from the bank. Now, the bank is not aware that you're taking over this loan and they do not like it. So, if a bank becomes aware that you have taken over a loan without their permission, and they can utilize what's called a due on sale clause. And this means that all the money that's owed to the bank, you have to pay as soon as they tell you to do so. So keep in mind with subject to, they claim it's a small chance, and I believe that it is a small chance, but you need to be prepared if that chance does come up. And so if they call the note due, you either have to pay that off in cash, you need to refinance, or you need to sell the property. The hard part with subject to is that if you need a refinance, a lot of times that kills the deal. You bought it for a low interest rate and now it's at market rate. The other risk with subject to is that let's say the original seller goes bankrupt. Now, the bank is going to come after assets or loans that are in their name. And if you think you own that property, the bank is going to have a conversation with you to try and recoup what they're after. Now let's talk about seller financing. Seller financing is a lot more clean. That's why I love seller financing, because you are working directly between you and the seller. There's no third-party bank. So what happens is that gives you a lot more creativity. So let me break it down like this. In terms of seller financing, you can negotiate on 5 terms. You have your purchase price, you have your down payment, you have your interest rate, you have your amortization schedule, and you have your balloon payment. Balloon payment is when the lump sum is due. So at the end of the balloon period, you got to refinance, you got to sell, or you need to pay off that portion. So that's why I like seller finance, is because you can negotiate all 5 of those with as much creativity as you wish. With subject to, you can negotiate on a lot more of these than you could with just the bank, but you have a floor and a ceiling because there is an underlying mortgage in place. If there is an underlying mortgage in place and they have a 5% interest rate, with the bank, it's going to be hard to get a 3% interest rate because that's below what they're paying. Now, I'll rewind that when you work directly with a bank, of all those 5 terms, the only thing that you can negotiate is purchase price. So in the creative finance world, it gives you a lot more freedom to negotiate on the other terms. So seller financing is what I prefer because of all the flexibility it allows. However, there are circumstances where I will still do a subject to deal. There are circumstances where I will still represent a seller on a subject to deal. As long as the people that I'm representing understand the risks, I can support them in that. Now, I will agree that there is a slim chance that a note gets called due, but I want my clients to really understand that concept. There are risks involved with these strategies. There are too many investors that will just throw people in deals and not fully communicate the risk associated. That's what happened with me when I lost all that money. It was a subject to deal. I have another video, you can watch it here, of how I lost that 180 grand. But be wary out there. These are awesome strategies, but I choose to go with seller financing mostly because of the flexibility with the terms, but also because it feels a little bit more above board. I'm not going behind the bank's back, and so I can scale. I hope you like this video. Please subscribe and like, and I'd love for you to follow me on my journey.